In this video, we're going to continue going through our multi-step income statement, and we're going to be looking at the items that will appear below operating income. We're going to present to our users other income and expense items, and these are going to be comprised of two main types of revenue and expenses. We have our investment related income and expenses, and we have income tax. For our investment related expenses, here we're presenting two types of interest related items. One, interest revenue, cash that the business is earning by investing its excess cash in some type of debt instrument that pays interest, such as a T-bill, a corporate bond, commercial paper, or say money market or CDs. And we have our interest expense, which relates to borrowing costs to purchase operational assets, to provide working capital for the business, to provide for business acquisitions. These could also include items that relate to investments. We could have dividend revenue. We could also have realized gains from the sale of investments. And an interesting item that we'll talk about more when we talk about the statement of cash flows, on the income statement, interest expense is deemed to be outside of operating income. However, interest expense is classified as an operating activity on the statement of cash flows. Now, this is in kind of a disconnect that the FASB has noted, and there are some changes coming, but we'll talk about in a different video lecture. For now, understand that after operating income, we're going to present revenue and expenses relating to non-operational items, typically involving financing for interest expense or investing for interest revenue, dividend revenue, or gains and losses from the sales of investments. Typically, gains or losses from the selling of equipment are reported one of two ways: included in the restructuring costs. And as we'll talk about in Intermediate 3, for most large public companies, a technique is used to adjust accumulated depreciation when assets are sold or scrapped, as opposed to recognizing a gain or loss, which you probably did in your principal classes. We then present the total of these other revenues and gains that will either increase or, in this case, decrease operating income. And we have a line item called income before taxes. And again, in the case of kitchen sink, they not only have income taxes, they also have an extraordinary item, and they have discontinued operations. We'll be talking about extraordinary items and discontinued operations in a later video. Now let's turn our attention to income tax expense. Income tax expense, kind of slipped there, is an estimate based on accounting income before taxes. This is a match to the revenue for the period, not the amount that is going to be reported on a company's tax return. We'll talk more about how income tax expense is recognized and measured in Intermediate 3. After we subtract out income tax expense, we have our next subtotal, and that is income from continuing operations before the extraordinary item. This number, coupled with operating income, provides the users with the best predictive value for what a company's operations will be in the future. So these are two highly analyzed numbers. In our next video, we'll take a look at discontinued operations and extraordinary items and how these are presented on the income statement.